Stagflation is a challenging economic condition marked by high inflation, stagnant economic growth, and high unemployment occurring simultaneously. This combination is unusual because inflation typically coincides with growing economy and job creation. However, in stagflation, these negative factors converge, creating significant economic hurdles. For the Indian share market, stagflation presents a very unfavorable outlook. High inflation reduces consumer buying power, leading to decreased demand for goods and services. Companies face rising costs from inflation but struggle to pass these on due to weak demand, which severely impact their profits. When economic growth stalls or declines, businesses often cut back on investments and lay off workers, increasing unemployment. This further dampens consumer spending, creating a vicious cycle that hurts corporate earnings and investors' confidence. Growth stocks, whose valuations rely heavily on future expansion, typically suffers the most during stagflation. Conversely, value stocks and defensive sectors like pharmaceuticals and utilities, which provide essential goods, tend to fare better as demand for their products remains relatively stable. Gold is also often considered as a safe haven. Central banks like the RBI face a dilemma. Raising interest rates to combat inflation could further stifle growth and worsen unemployment, while lowering rates to stimulate the economy might escalate inflation. India experienced stagflation in the 1970s following global oil shocks. As of 2025, India is projected to be a fast growing economy with moderate inflation, suggesting the current risk of stagflation is low. Addressing stagflation usually requires a mix of monetary and fiscal policies focused on increasing the economy's productivity capacity through structural reforms.